Hi friends, my name is Amandeep Singh and I'm a CPA by profession. I manage a public practice firm called Cloudiver CPAs Inc. Today, I'm going to talk about how to navigate through divorce-related taxes. A friend of mine told me about a serial entrepreneur in Vancouver whose name was David. He kept trying to hit it big. In more than 25 years of trying to operationalize several businesses, none of his ideas worked. Finally, his wife Linda gave him an ultimatum. She said, "This idea better work or I can't keep funding your ideas." Sadly, the last idea also flopped, so did the marriage. Did you know that divorce lawyers estimate that entrepreneurs' divorce rate is 5 or 10% higher than the national average of around 40%? Recently, separated couples are not just having to coordinate parenting and who gets the dog, but they also have to deal with various tax implications. This video covers the main points, which are just the tip of the iceberg covering broadest tax entanglements of marital matters. And although it refers to spouses and legally married couples, you should understand that the Income Tax Act handles common law partners identically to married couples. You might ask, why should I ever talk about taxes related to divorces, and why is it so important? For most of you, here is why. If you were told as part of your divorce settlement, you could get around 20% more money just by how you structure your divorce settlement, you would probably want to know that. Or if you are on the other side of things and you could save 20%, approximately 20% in expenses or assets, you would be listening closely as well. The answer is simple. It is because of taxes, as the taxes are critically important. Various tax-saving opportunities help in availing valuable tax credits and refunds at a time when you're likely moving from two incomes supporting one household to two incomes supporting two households. Okay, let's start with basic points which you need to understand. Number one, understanding when the Canada Revenue Agency, which is also called CRA, will consider a separation to be valid. A separation which is shorter than 90 days is not considered as a separation for child and family benefits. For the child benefit, the CRA may recognize you as being separated if you live in separate households. However, if you continue to share parenting and financial responsibilities in the same household, the CRA may not recognize your separation for child and family benefits, and also for the GST or HST credits. Number two, always inform CRA. The CRA exacts you to notify them by the end of the month following the month that your divorce takes place. Number three, keep receipts and important information. Marriage is a private affair where your incomes may be combined, expenses distributed, and who gave what to who gets typically messy over time. Unfortunately, after separation, it's very important that you be more business-oriented, as keeping records and receipts such as canceled checks proving past payments, T1 tax returns is critical. Number four, prepare for split of family assets. I meet a lot of people who think that divorce means that we just divide everything equally 50-50. We always keep hearing the same thing. Well, I'm here to say that this is not always true. There is no cookie-cutter solution. So how does the split works? Well, in BC, we have something called equalization payment. what equalization payment means. Equalization is a fancy legal term for money payment, which one spouse pays to other to make life equal. This payment might be in the form of cash, RRSP transfer, pension transfer, or even through the transfer of your residential house. I will discuss these one by one later in the video. Now, all the assets acquired before your marriage or gifted for marriage need not be split, as they are considered assets belonging only to the person that holds legal entitlement. The net worth, which is assets minus liabilities, is calculated both at the date of the marriage and the date of the separation. This period is also called the valuation date. By the way, this valuation is done both for you and your spouse. Well, you might ask, why is this even done? This is done because the law looks at the increase in net worth of each party from marriage to separation. In determining your net worth, your assets, such as a house or investments, for example, will get valued at fair market value. These will attract tax on the difference between the fair market value and the cost which you originally paid for them. However, for an asset transfer in divorce, there is a strategic financial option that allows you to use what's called an automatic rollover provision under subsection 73(1) of the Income Tax Act in Canada. The following types of transfer of property are tax-free. Number 1, a transfer to a spouse, or number 2, a transfer to a former spouse arising as a result of the settlement of spousal rights. Please do not forget that the rollover does not mean you will never pay tax on that asset. It just only means that it indicates that a transfer done as a part of the separation agreement will get tax deferred to the future. Number 5, the pension. The valuation of the pension plans is based on many assumptions, such as the rates of return prevalent in the market, the age of the retirement, etc. Based on the articles of the pension plan, it may be reasonable to do a pension income splitting at the source so each spouse receives pension benefits undeviatingly. On the other hand, where there are sufficient family assets, you might decide to trade other assets rather than splitting the pension. It's your choice. For example, your spouse may get to keep the house while you retain the full pension. If the pension plan so allows, it might be possible to transfer some or all of the value of pension plan on a tax-deferred basis to your spouse. Now, if you receive a pension at the time of separation or divorce, the non-member spouse to your pension plan may be entitled to receive part of the monthly pension. I just wanted to tell you because many people don't recognize this. Number 6, Canada Pension Plan. You or your spouse may independently apply for a split of your CPP credits, that is the Canada Pension Plan credits. And if this happens, the credits built up by both of you during each year of the marriage will get combined and then split equally later on. Alternatively, you may elect not to divide the pension. For example, if you and your spouse have made maximum contributions during the relationship, then you don't need to get a CPP split. Number 7, Registered Retirement Savings Plan. Now, RRSP are very famous in Canada, and it is the most significant tax opportunities which are available to individual Canadians. And the RRSP do not need a valuation as their value is always equal to the account balance. Transferred to a spouse's RRSP or RRIF on a tax-free basis if the following conditions are met. Number 1, the former spouses are living apart. Number 2, the payment is made according to either a decree judgment or order of a competent tribunal or a written separation agreement. Number 3, the transfer is made directly between the RRSP or the RRF plans. It is important that the funds not be withdrawn from your spouse's RRSP and provided to you for RRSP contributions, as your spouse will have to pay a large amount in tax on the amount of the withdrawal. Moreover, you might not have sufficient deduction room to contribute the full amount to your RRSP. The relevant form for the transfer is to be finished by both spouses and the administrators of the transferring and acquiring RRSP or RRIF. Number 8, Canada Child Tax Benefit. Now let's discuss something about the kids. The Canada Child Tax Benefit, which you receive as a tax-free monthly payment for your children, is based on family income, including combined income of you and your spouse. It aims to help eligible families with the cost of raising kids under the age of 18. If you are separated or divorced, then just your income will be used in calculation for the Canada Child Benefit, which you are entitled to, as your spouse's income is not counted for determining the child tax benefit when the case is for a separation or a divorce. Therefore, it's possible that you might receive an increased amount of the Canada Child Benefit after the divorce or separation. If you have shared custody of your children, you may have to share child benefits with your ex, as the CRA may divide the benefit 50-50 between you and your ex. Number 9, principal residence. Now this is very important. The value of all the family assets, including the principal residence, must be determined for the division of property. If you and your spouse jointly own a couple of properties together, such as a family home and cottage, you can designate one of the property to each of you at the time of separation. The profit which you pocket on the ultimate sale of either the family home or the cottage will be sheltered, at least partially, by the principal residence exemption. So you don't have to pay taxes usually on these type of transfers. You need to bear in mind that you can claim the principal residence exemption on one property for any given year, and the property must be ordinarily inhabited by you. Alternatively, you might decide to sell house or the cottage and claim the principal residence exemption on the transfer of a principal residence, providing a higher cost base to your spouse. Now, you might ask, why would you want to do that? Well, because the higher cost would mean less taxes for your spouse in the future when they are actually trying to sell the house. Number 10, certain legal fees are tax deductible. Now, many people don't know that if you have to pay legal charges to your lawyer to collect support payments, the CRA will allow you to deduct these fees. Any legal expenses paid to your lawyer to prepare a separation agreement or negotiation of the division of the family assets is generally not tax deductible. Number 11, eligible dependent tax credit. In case you have primary custody of your children, the credit may go to you. Whereas, if you have children through joint custody, then decide whether you or your spouse would claim this credit. Both you and your spouse cannot claim the credit at the same time. The credit can be claimed for one qualifying child annually. And if you have more than one child, you may pick which one to declare for this credit. You may also decide to claim one child 1 year and then the other the following year. Remember that any income the child earns gets deducted from this credit dollar for dollar. If you make child support payments, you may not be able to claim this credit. A recipient of child support payments may claim the credit. Number 12, childcare expenses. On separation, the higher income earner or lower income earner rules which drive the amount of childcare deductions do not apply. Each of you will be permitted to deduct childcare expenses paid personally while the children are in your custody, as long as the costs are incurred to help you earn business or employment income or allow you to attend school. In shared custody, each party can claim expenses incurred that otherwise meet the requirements, notwithstanding the amount claimed by the other spouse. Number 13, spousal payments. Spousal support payments paid for spousal support are deductible to the pair if certain tasks prescribed by the CRA are met. Now, many people ask me about lump sum spousal payment. Well, these are not taxable to the recipient or deductible to the person making the payment. In general, amounts that are tax deductible to the pair are included in the income of the recipient, which might bump you into a different tax bracket. Lastly, apart from taxes, please remember that the amount of support paid or received can have unfavorable effects on your ability to qualify for a mortgage. If you expect to receive spousal support payments, you might want to increase the taxes deducted at source to avoid massive tax bill when you're filing your tax return. This can be achieved by submitting a form called TD1 form. Number 14, child support payments. Now, child support is tax exempt in the hands of the person who receives the support, and the person who pays it cannot claim the support as a deduction either. I know these tax issues might sound frightening to you at a time when you're already going through a crisis. Sometimes it may be hard for you to understand how to apply the general information regarding divorce and tax rules to your situation. Your divorce or separation agreement can be complex due to many variables such as blended families, pension income from several sources, multiple ex-spouses or common law partners, significant amount of money involved, and uncertain tax issues causing conflict between the separating and divorcing spouse or common law partners. Even if your situation seems straightforward, there may be some tax-related twists and turns which might put you in an unfavorable tax situation. Changes in your marital situation can have significant implication on your taxes and your financial situation. If you are going through a divorce, don't automatically expect the CRA or the courts to make reasonable decisions for your benefit. Filing the final divorce papers may give you a sense of relief, a sense of completion and closure, but the existing settlement proposal might not take into account the effect of taxes and the present value of money on the amount of support or the value of the properties to be divided. In this situation, what do? Well, your CPA can suggest an equalization amount that takes these considerations into account and give you a good solution. To make sure you're not financially disadvantaging yourself with unwelcome tax surprises later on, you should forward the analysis from your CPA to your legal counsel to negotiate a final settlement in your favor. Thank you for watching this video. Please subscribe to my YouTube channel for more videos on cash flow management and tax planning. Cheers and have a good one. Bye.